Metals and Markets is sponsored by DNA Precious Metals, a near-term producer of the Montauban tailings mine in Quebec, Canada. DNA Precious Metals trades on the OTC BB market under the symbol DNAP.
This is the Doc and Eric Dubin with special guest, Precious Metals Fund Manager Dave Kranzler joining us today for the SD Weekly Metals and Markets. I'm glad to have you here, Dave. Thanks for joining us.
Oh, thanks for having me. It's my pleasure.
Kind of a subdued week in the markets here with the holiday midweek, really the half-holiday Tuesday, and then all the markets closed on Wednesday. A nice close to the end of the week here in the precious metals markets with gold and silver moving up both Thursday and Friday. Silver on Thursday popping from 1940s right up to 20 and kind of being sold off throughout the rest of the day Thursday, but then actually spiking up through $20 here today on Friday, maintaining that level throughout the afternoon, throughout the close. Just above $20, and then gold also a move up through 1,200 earlier in the week, and then on Thursday and Friday up through 1215 and closing just at about 1215 at the week here. So it's not a big move, a big strong move off the bottom that some people were looking for. What's your thoughts, Dave? Have we seen a double bottom in gold? Are we going to get a retest of that 1179 level? Are we back above 20 in silver and 1,200 in gold for good now?
With all of the intervention that's going on in all of the markets, not just the precious metals, I'm kind of loath to put a bottom call out there. I've done that a couple times in the last year, where I've called a bottom, and then all of a sudden we go lower. Certainly, from a technical standpoint, you could say that. It looks like a double bottom here. It's just, I'm just amazed at the degree to which the official sources out there are able to keep a lid on this market. I mean, every single indicator that you look at is screaming huge short squeeze ahead of us. In fact, I think Rickards is out saying that there's going to be a massive short squeeze in gold in 2014. And it's certainly, when you look at commitment of traders reports and the sentiment, I mean, I don't think it's ever been this low, at least since, the 1980s. So, every single contrarian indication out there is telling us this should be the bottom, but, you just never know. I think there's a good possibility that it is.
Thoughts, Eric, now with about a week's trading behind us since the recent bottom in gold, about 1190 or 1188, in silver I think traded as low as 1915.
The punch in the nose post-tapering. What's interesting this week is that, particularly today, you can see that even with the paper jockeying, once London was open and then going out throughout the London trade, there was a lot of pressure on the price that you typically do see when the cartel is active, manipulating downward. But both today and yesterday, we saw a rather large short covering spike higher associated with the COMEX opening plus minus 5 minutes. And it looks like the assistance factor that has come with the paper jockeys and the hedge fund community and the momentum crowd that piggyback on the signals that the cartel can put out there. And just as context, then one of the last shows we were doing when we were talking about the aftermath of the tapering event, where in the 2:40 and 2:41, 2:42 a.m. hour on Thursday, when it was very clear that the cartel had initiated really fast selling of trading of somewhere in the neighborhood of about 5,000 contracts of gold, that pushed the trade down and painted the tape for all the copycat selling that comes with the hedge funds and whatnot. That whole dynamic that we were seeing in this whole period since basically November, every once in a while it begins to fade when we get to localized bottoms, when we're retesting these lows. And today and yesterday actually fall into that pattern where, the market is trying to bottom, and you see the example of the hedge fund guys covering for the assumption that, that they're not going to get as much downside, and the risk-reward from their perspective is much more dangerous because it seems like the cartel isn't pushing as much in the last couple of days, and there hasn't been very much copycat selling. So as soon as the COMEX opens, where there's a higher concentration of these paper trading manipulations as compared to the percentage of off-take market concerns where the London bullion market is more of a physical market, you see that pattern. And today speaks to hedge fund covering and the cartel being somewhat quiet. So who knows? I mean, we're at the end of the year now, and starting next year, you won't have as much tax law selling when it comes to the gold mining shares, and maybe the whole market will have settled down a little bit. And on top of all of that, we're moving higher in the 10-year interest rate structure, the long end. We're now at 3% today for the first time since the last move when the Fed had made their announcement a month and a half ago or so. So definitely interesting trading going on. It kind of speaks and confirms to an attempt to bottom, but like Dave said, time will tell. There's a lot of dead bodies of prognosticators lying around after having made many a call this year. And
there has to be quite a bit of profit booking of hedge funds that have been short throughout the whole summer and into the fall, into year-end here with the last 3 or 4 trading sessions of the year booking profits for their book. We wanted to stay on the precious metals topic here a little bit before we kind of move into real estate and talk to Dave about that a little bit. But specifically, the massive amount of gold, physical gold, that's being withdrawn from Shanghai this month. There's been quite an astounding amount withdrawn from Shanghai over the entire year, but the totals really have picked up here in December. Just in the 4 or 5 day period from December 9th to 13th, there's over 50 metric tons of gold were withdrawn from the vaults in Shanghai. And just to kind of put that number in perspective, 50 tons withdrawn in 4 or 5 days in less than a 1 week period. Contrast that with the Bundesbank and the Germans, who have been able to successfully repatriate about half of that of their own gold from the New York Fed in 14 months. Dave, what's your thoughts on the massive amount of physical gold that's being drained out of Shanghai? I think year to date, it's something like around 2,100 tons have been withdrawn from the Shanghai vaults. And according to the People's Bank of China, that roughly is equivalent to the Chinese gold demand. So I'd like to get your thoughts on that, Dave.
Yeah, it's actually kind of a two-pronged subject here because, in my mind, probably one of the most extraordinary stories of 2013 has been the unbelievable withdrawal of physical gold from the GLD Trust. I mean, it's lost, I don't have the exact numbers in front of me, but it's lost over 500 tons since, I think, December 12th or 15th last year. And that's almost 40% of the gold that's in GLD. And it's kind of like, where is this gold going? Well, I think obviously we know it's headed over to China.
Via Switzerland.
But, via Switzerland. But the other thing that's interesting about that is that there, anti-gold bugs are out there saying, "Oh, well, see, look at all the gold that's leaving GLD. That tells you no one wants gold anymore," which is just completely incorrect, because it's not the selling of GLD shares that triggers the withdrawal of gold from the GLD Trust. It's the authorized participant banks, and I forget the exact number. There's 11 or 12 of them, but the primary ones are the JP Morgans and Deutsche Banks of the world. And the only way that gold leaves the trust is if these banks accumulate 100,000 share blocks and redeem it for gold and take the gold out of the trust. So it's not the selling per se of individual retail investors or institutional investors that triggers the removal of the gold. It's the banks themselves who are taking the gold out. And it's why are they taking it out and where is it going? Well, the second part of that topic is it's obviously going over to China, and to what degree it's ending up in the public's hands over there versus it's ending up in the People's Bank of China, the central bank there. There's no telling, because the government, the only gold that gets publicly reported as going into China is the gold that goes to non-government sources. The government doesn't report the gold that goes into China that the government keeps. So, the other part of that equation is China mines 400 tons of gold a year, and none of that leaves the country. So I think we have to assume that 400 tons probably ends up in the central bank's vault over there. So, like you say, it's kind of a moving target in terms of how much gold is actually being accumulated over there, because the only thing that we can have some confidence in is the stuff that gets reported as being imported through Hong Kong and or exported into China from Switzerland, or the stuff that's taken off of, delivered from the Shanghai Gold Exchange. You mentioned 50 tons last week. It was actually 57 tons, and most of it coincided with, there were two very large withdrawals from GLD last week, and that coincided with massive, there was a day lag, but then massive deliveries in Shanghai. And then today and yesterday, another 26 tons were removed after, low single digits for most of the week. But when you see like deliveries on Shanghai go down, it's more than likely a product of gold not being available to be shipped to the Shanghai exchange, as opposed to lack of demand.
Yeah, that's just amazing. Like 26 tons in 2 days. Like I alluded to before, that's basically what Germany has been able to repatriate in 14 months.
I think the number I saw for Germany was like 13 tons or something. I can't remember. It was an absurdly low number.
Yeah, and
it wouldn't be unexpected. I mean, we all know the gold's not there to be shipped, and to the extent that the Fed's trying to call in gold off of leases or whatever, I think they're having trouble because it's all got to go to Shanghai. I mean, the Fed can default on Germany, and they wink at each other. But if there's a default into Asia, that's the type of thing that leads to wars. It certainly would expose the fraud that the Western fractional bullion system is.
Right.
So, and I'm sure you guys saw the same rumors I did, but when we had that massive smash in April, after that happened, it started leaking out that there were a couple of the big bullion banks there, and I'm assuming it was JP Morgan and probably either HSBC or Deutsche Bank, were in danger of defaulting on deliveries to China. And so what they did is they engineered that smash to get as much physical gold coughed up as possible. Well, it created GLD selling, and JPM just catches those shares and turns them in and takes the gold out and ships it to China. So,
and it also made China's demand on the retail level quadruple within a couple of months, and then the problem just only exacerbated itself.
Yes, that's correct. And we actually, our firm subscribes to a very expensive bullion market report, and the guy unearths data that, I've tried to replicate it so we didn't have to pay for the report and I could do the work myself, and I can't get it done. It's a guy named John Brimlow. You've probably seen his work.
Right.
And the same thing happened when they took gold below 1,200 again. All of a sudden, there was massive retail demand over there. It just triggered, and it's continued on through this week. So, I kind of have a theory, and again, there's no way to prove this, but if you notice, gold doesn't stay below 1,200 very long. And if you've seen a lot of reports out there are now talking about how the all-in cost in general for the large miners to get gold out of the ground is $1,200 an ounce. When you add in the non-cash costs in addition to the cash costs. And we also know that the government of China has direct contracts with a lot of these big global miners to buy gold directly from them. There's been several mining executives who have talked about those deals in various conferences this year. My view is that there's probably a trigger point in those contracts such that if the price of gold goes below 1,200, these mines don't have to produce gold to ship to China. I'm sure they have a flip, sort of a flip price in there below which they just told China, look, we're not going to sell you gold at this level because that's below our cost of production. And so I'm almost, again, there's no way to prove it, but it's the only thing that makes sense to me in terms of why gold doesn't stay below 1,200 very long. And it also seems to trigger a lot of buying over there on their retail side. So
those 2 points I'd agree with. I think that's going on in a more of a speculative analysis as well. I think on this side of the pond, so to speak, we see a lot of interest in the speculative community to just cover their shorts at that level, given the technical analysis picture that we see. I mean, that's just kind of goes without saying. That's obvious. But even more refined, there probably is quite a bit of financing activity for struggling miners going on where the bullion bank financing sector is saying to them, look, you need to pledge some of your forward production at $1,200, and at the cost of production being where it is on an average basis. It just so happens to coincidentally correspond to that same possibility of gold funding for China with their relationships to miners. And if we're seeing forward sales coming in at this point and on a contractual basis, that kind of cements the ground a little bit more as well for 1,200 being kind of a sticky price point where it's harder for the price to fall below that on a gold basis, and probably something similar going on with financing with silver as well too, with maybe the $18 price range or $18.50 or so being an important point.
You bring up silver. That's a whole other interesting point that no one's really touched upon. Just to circle back really quickly to the gold thing and the looming, what I think is going to be a gold bullion shortage. And I've been told by people with connections into the government that this is the correct view, that the U.S. government put heavy pressure on India to do something to curb their imports. Because notice how those curbs went in place right before the strongest part of India's seasonal buying year. I think the curbs went in place in July or mid-August, and that's late August is when India really kicks into gear. I think that the Western world didn't, between what China was importing with no ability to stop it and what India would have been importing in the third and fourth quarter this year, I think you would have seen massive defaults.
Yeah,
and I'm convinced. Well, I'm convinced that the U.S. had a heavy influence in India implementing that policy, and I've been told that view is correct.
India is more pliable as well too on an international banking system.
Well, the U.S. kind of is their defense dog over there in that part of the world.
And they're nowhere near as strong as China, and also their problem with their rising rupee, or their the rupee falling in their trade current accounts and going against them. They wanted to stop the heavy importation of gold.
Well, that was the cover story.
Right, exactly. And
but what the interesting corollary to that is, aside from the fact that the smuggling has gone parabolic,
right,
the smuggling of gold into India, but it hasn't come close to making up for what they would have imported without the capital controls in place. But it triggered an avalanche of silver buying over there.
Right.
And I don't have the numbers off the top of my head, but since July, India has imported an extraordinary amount of silver. Now, from a dollar standpoint, it's nowhere near the amount of total dollars that would have been spent on gold if gold were continued to allow to have been freely imported. But it's an incredible amount of silver. So at some point we're going to see, the impending silver shortages, above ground silver shortages, just like we sense is there in gold.
And just to substantiate your thoughts, Dave, on that the West likely gave down some sort of a ultimatum to India. We've discussed it several times on the show here with Metals and Markets, but a lot of people aren't really aware of the fact that last October, Bernanke and Geithner together made a 2-day visit to India. It was the first time in the history that a U.S. Fed chairman had met with the Indian finance minister. And they had 2-day high-level talks with India's finance minister. And sure enough, the next holiday season in India, the clamps are put down on gold. So it was really only 4 to 6 months after that visit that India began clamping down on gold.
Yeah, I think it was.
You're right about that. I remember when I saw the news report of Bernanke and Geithner going over there, and I didn't really think much of it at the time. But you're right. There probably is a direct connection there.
The import taxes actually rose not too fast or not too soon thereafter that meeting. The timing was kind of fishy, and definitely suspect that there's probably a link to what the U.S. was pushing them and India's restrictions on their gold market. But even in May, when the first reaction to the COMEX drive-by shooting of April 12 through 15, India reported something on the order of about 190 some odd metric tons imported in the month of May, if memory serves me correctly, somewhere in that neighborhood. And then he said, "Oh, whoops, sorry, we actually overestimated by twice what we actually imported because the number was so shocking. I mean, it represented about 25% of what they normally would import in any given year, and that was just for May. But all told, this year, I suspect we're going to see them report officially maybe 800, 900 metric tons, but when you add on 300 metric tons of smuggling, it'll be an all-time high import year for India. All the while, when China could be importing as much as 400 metric tons from all the different sources that they have going. So the end game has got to come pretty soon because there's just not enough gold to match that level of importation with 2,400 or 2,600 metric tons mined each year, and 2014 most certainly going to be seeing a lot less gold coming out of the ground, given mine closures and temporary setbacks with time schedules of companies and whatnot, given the low price.
I want to shift gears or topics a little bit here to Dave to discuss the U.S. housing market. I know you've been pretty vocal on your Truth in Gold website, calling for another real estate crash. So what type of crash are we looking at in your opinion, Dave? Is it going to be worse than 2007, 2008? Is it going to be similar to that? And what's the time frame that you're looking for of real estate?
Again, with the time frames.
Speculate.
Actually, the way my overall thesis with the housing is that the bear market in housing kind of technically started in mid 2005, and if you look at the charts, I used the Dow Jones Home Construction Index as my proxy for the home builders, and it's also a good proxy for the housing market in general. But that topped out mid 2005. And it fell all the way down. It was topped out, I think, a little over 1,000. And it fell all the way down to under 200. And really, what we're seeing right now, that started, it bottomed in 2008, and then it kind of took off again in late 2010, early 2011. But what's happened is you've had this so-called recovery in the housing market, but it's been fueled by an enormous amount of federal government and Federal Reserve stimulus, over a couple trillion between what they started putting into the market in late 2008 through today, as a matter of fact. And what you also had was obviously a huge trend of private equity funds and hedge funds going out and buying up all this distressed real estate and trying to convert it into rental properties. And it was a quest for yield is really what it was. You got long-term treasuries yielding, 3% at the time when the trend started, and at least using their Excel spreadsheets, they were calculating that they could get a 6% return. I think that was sort of the cap rate being used for the models to go out and buy up big tracts of distressed housing, and that took a lot of supply off the market, and also changing the accounting rules and things like that, and that's allowed banks. Part of this QE, as you've noticed, banks have accumulated an incredible amount of a couple trillion in their excess reserve accounts at the Fed. It just sits there, and what that's allowed banks to do is stop foreclosures, and they let houses that aren't paying mortgages, they let the people just live there. So there's at one point, and I don't know if this number is still good, but at one point banks were withholding 90% of their foreclosures from the market. So you kind of, what happened was you had the federal government working with the Fed and with the housing industry to create an artificial supply or an artificial shortage of inventory. Well, there's really not. There's a lot of inventory available, but it's sitting on bank balance sheets, and they can afford to keep that assets on their balance sheet because of all the money being pumped into them by the Federal Reserve. So, and then I've also, in terms of the price increases that you're seeing, that's highly artificial also. And the bogey everyone uses is the Case-Shiller index, and I've reviewed on my blog why that index is problematic. So the price gains that make the headlines aren't really the price gains that someone would get if they bought a house in 2010 and sold it today. I mean, they'd still have a nice price gain in there, but not the type of percentage increases that are hitting the headlines. There's one more factor in here that's fueled that. Back in 2008, the FHA, the Federal Housing Authority, was only financing 2% of all mortgages. And over the last 5 years, it's grown into financing over 20% of the mortgages. And a lot of those mortgages that it started underwriting and guaranteeing replaced the subprime crap that was being underwritten by the Countrywides and the Wash Mutuals. So the FHA stepped in and filled a void, and so you're still seeing a lot of junk mortgages being issued to people who really can't afford them. And you're starting to see the FHA delinquency and default rates spike up. In fact, I think the last time I was looking for it, I think the 2009 cohort of FHA mortgages has like a 30% delinquency rate on it already, and 2010 is already in the double digits. So the net of it is that you had this extraordinary stimulus that created what I call a dead cat bounce in the housing market. And I think it's getting ready to roll over. And if you look at the numbers, notwithstanding the new home sales farce that was released last week by the Census Bureau, if you look at the numbers, and you look at them sequentially since May or June, both pricing and volume peaked in June, and it's been going down at a pretty quick rate in terms of existing home sales and new home sales until that report the Census Bureau tried to feed us last week. So what I think happened is I think some people who were underwater in their homes and got to stay in them were able to sell them, and that created some of the volume that we've seen during this bounce. And then obviously the institutional investors coming in and buying up these big tracts, and they've stepped away, by the way. That right. The private equity / institutional buying of real estate stepped away. And in some of the markets where it got to be bubble levels again, especially some of these southwestern cities like Vegas and Phoenix and Southern California, all of a sudden now you're starting to see a lot of empty homes. There's a huge inventory of homes for rent. Because the problem is a lot of people who were displaced from their homes when they got foreclosed on, they can't necessarily afford the rents that make it economical for the institutional buyers to earn their 6% cash-on-cash return. So they just continue renting apartments. And it's actually become real problematic in Vegas. And then another thing that's not being talked about that you got to layer in there is that starting Jan 1, the FHA significantly reduced the size of mortgages conventional mortgages that it's willing to guarantee. And in some markets, like the Vegas market, they've taken them down from like $350,000 to $280,000. So that's going to start putting brakes on home sales as well. In addition, there's underwriting standards that'll kick in from the Dodd-Frank legislation. And it's going to make it harder for people to get even, the standard conventional mortgages. There's going to be tighter credit standards imposed. And at some point, they keep deferring it, but at some point, Fannie and Freddie are going to reduce the size of their conventional mortgage. Now, it was supposed to kick in, I think, January 10th, and it got deferred. And I'm sure it got deferred because the housing industry said, look, if Fannie and Freddie reduce their mortgage limits, it'll cause the housing market to crash. Well, I think the demand side of the equation is falling off quite a bit in this latest bounce. And I think you've got, especially at these price levels with these interest rates, I think you've probably saturated a good part of the demand market. And my expectation is that in the first quarter of 2014, we're going to start to see an avalanche of homes for sale on the market, and you're going to start to see institutional investors unload portfolios. That already started in 2013, actually, with the institutional investors unloading a lot of what they bought. At least some of them have. And I think everything that's happened over the last 18 to 24 months to drive prices higher and drive volume up is going to reverse itself in the first quarter to the first half of 2014. So in terms of a time frame, I think by the middle of 2014, things are going to look really ugly again. And in terms of how low it'll go, again, I hate to put targets on it and time frames, but I do think that we could easily see that the Dow Jones Home Construction Index go back to the lows that it hit in 2008 and maybe even go lower than that.
And to top it all off, at the layer on top, the rising interest rate structure.
That's right, interest rates. I was just looking at a chart of the 10-year today, and it looks like the chart of the S&P 500. I mean, since mid-October, it's gone up at a 45-degree angle almost without pause.
Yeah, and that spike that we saw in the housing market over the last 9 months or so was people rushing in, taking advantage of the low rates because they knew that they'd eventually go up, that the Fed would lose control. And we are now in the beginning stages of the Fed losing control. And all this talk of taper is only going to push that further. I mean, that whole market charade of manipulation that was wrapping the tapering announcement is only good for 1 week of BS. And now we're beginning to see markets revert to normal economic forces with, amongst other things, the 10-year going up, as it should. The bond buyer of last resort, the Federal Reserve, curtailing their amount of purchases only means one thing, that the rates have to go higher.
Yep, no question about it. Speaking of that taper day, I think what we saw was just an extraordinary, probably unprecedented amount of intervention that went on in the market.
It was quite the theater.
That's right, because the initial reaction is what you would have expected. Gold got hit and then it bounced, which is what I thought would happen if they announced a taper.
Stocks went down too, and then they were magically lifted higher, and then short covering came in and blew them up to 280 or whatever it was up on the Dow, if I remember correctly. And
yep, that's right. I mean, it was unbelievable, and it had to have been a massive intervention.
Yeah.
Well, so Dave is looking for a big correction in housing over the first quarter to half of 2014, undoing a lot of the gains over the last 3 or 4 years, thanks to the Fed and their policies. So,
well, I wouldn't even call it a correction. I'd call it a resumption of the bear market trend that started in mid-2005. In other words, I don't think we ever hit a bottom in the housing market, and it probably would have, pretty quickly if the Fed and the government had stayed away from intervening in it. And I think they've, without taking some sort of outside of the box measures, like the Fed goes out and outright buys homes, or re-ups QE again in a major way, and the federal government even increases even more its subsidization of mortgages. I think at the level of intervention that's going on in the housing market now, both from a regulatory standpoint and an injection of cash standpoint, I think they've done what they can do, and they're going to lose control of it.
And all the gains that we've had to show for the amount of manipulation and participation of the federal government in the housing market is really just, it's a sad state of affairs. If this is all they can do with as much money that has been moved around, it's really pathetic.
Well, that's right. And in fact, I mean, I know at least in the Denver market, and I'm sure it's true in most other major metropolitan markets, let's say someone was talking to a real estate broker in June about selling their house, and the broker said, yeah, I can get you X for it. There's no way they would get even close to X right now if they listed their house now. It would be, I bet it would be at least 10 to 15% lower. A realistic price that would move the house.
It's a pretty big move in a short time there.
Yeah.
Well, you've already seen it in at least, they revised the numbers for new home sales when the Census Bureau issued that garbage last week, but the existing home sales, and this would be, a broad swath of the country, the existing home prices have already fallen more than 5%. Again, I don't have the number off the top of my head, but the existing home sale prices, the mean price has already dropped about 5% since June.
All right, well, before we wrap things up and let you go here, Dave, if you could tell our listeners about where they could find out more about your fund as well as your work. I know that we publish your work both on Silver Doctors and the News Doctors, but tell your listeners a little bit more about your fund as well.
Sure. The name of our firm is called Golden Returns Capital, and we do a wide array of financial advisory services. We're not associated with a brokerage or anything. We're independent advisors. And our flagship fund is called the Precious Metals Opportunity Fund, which invests in physical gold and silver, primarily 1-ounce sovereign minted bullion coins. We do have some bars in there that we've taken delivery off the COMEX. We keep them in a independent depository not associated with the COMEX in Delaware. And then the other part of the investment proceeds go into a pretty aggressive portfolio of mining stocks. And our distribution between bullion and stocks right now is about 70-30, maybe 75-25. The base case model is 50-50, but part of the decline in the composition of the stocks has been market related, and part of it was back in early 2011 we started putting more funds into bullion because we thought bullion would outperform stocks for a while. It was probably a lucky call, but and what makes our fund somewhat unique is that when an investor redeems their investment, they can take their pro rata share of the bullion as part of their redemption proceeds, and we'll deliver it to them wherever they want it delivered to. And that's part of the reason why we invest primarily in the 1-ounce minted bullion coins. Aside from the fact that they're the hardest form of bullion to counterfeit, and therefore the most fungible, but it also gives the fund fungibility in terms of distributing bullion if an investor wants to get part of their distribution in bullion.
All right, Dave Kranzler, our pleasure. Thanks a lot for joining us today. Look forward to speaking with you again here for the Doc and Eric Dubin. Thanks for tuning in once again to the SD Weekly Metals and Markets.
SD Bullion.